Hello, friends, and welcome back to the channel. Today I'm sharing something truly valuable with you. Trading in the Zone by Mark Douglas, a book that's considered a game changer in the world of trading psychology. Mark Douglas wasn't just another trading author. He was one of the first to clearly explain how the real edge in trading doesn't come from your strategy or indicators, but from your mindset. This book is all about helping traders like us break free from emotional decision making and start thinking in terms of probabilities, consistency, and confidence. Now, a quick note before we begin. Some of you might remember that I had uploaded a video on this book earlier. However, due to an objection from the co-author, I had to take that video down. But I didn't want you to miss out on this powerful content. So I've recreated the video with thoughtful modifications and packed it with just as much, if not more, value than before. This version may not go into as much detail as the previous one, but it still delivers everything you need to understand and apply the powerful psychological principles shared in this book. Whether you're a beginner or an experienced trader, these insights can truly shift the way you approach the market. So make sure to watch this video till the end. And if you find it helpful, don't forget to like, share, and subscribe to the channel. Your support means a lot and helps me keep bringing you more valuable content like this. Let's dive in. Chapter 1: The Road to Success, Fundamental, Technical, or Mental Analysis. In the beginning, most traders start their journey with fundamental analysis. It feels logical. Study the company, look at earnings, understand supply and demand, global news, and economic indicators. The belief is simple. If you know enough about the fundamentals, you can predict where the market is headed. It's an appealing approach because it offers a sense of control, almost like solving a puzzle. But Mark Douglas points out that for many, this approach leads to frustration. Even with solid research, the market doesn't always move as expected. Prices often behave irrationally, and traders get caught off guard. That's when many shift to technical analysis. Technical analysis feels like a breakthrough. Instead of focusing on why something is happening, it focuses on what is happening. Price patterns, indicators, support, resistance. It's all about recognizing repetitive behavior in the market. Traders start believing that if they can master the charts, they can stay one step ahead. For a while, this shift gives results. You feel like you're finally in sync with the market. But then again, problems begin to surface. Even the best setups fail. Sometimes, trades that look exactly the same have completely different outcomes. Confidence starts to shake. The trader begins to wonder, if I'm doing everything right, why am I still losing? That's where Douglas brings in the real turning point: mental analysis. He argues that the true key to consistent trading success lies not in the market, but in the mind of the trader. It's not what you know about fundamentals or how well you read charts. It's how you think, how you feel, and how you behave under pressure that truly makes the difference. The market is unpredictable. It moves in probabilities, not certainties. But most traders operate with the need to be right. That need triggers fear, hesitation, impulsiveness, or even revenge trading. In other words, emotions take over, and the method, whether fundamental or technical, gets lost. Douglas makes it clear. Success in trading isn't just about having the right strategy. It's about having the right mindset. The consistent winners are the ones who think in probabilities, accept the randomness of outcomes, and manage their mental and emotional responses. They don't try to control the market. They focus on controlling themselves. This shift from external analysis to internal awareness is what separates amateurs from professionals. It's what allows a trader to stay calm in chaos, stick to their plan, and execute with confidence no matter what the market throws at them. Chapter 2: The Lure and the Dangers of Trading. Trading holds a powerful allure. For many people, it represents freedom. The freedom to work from anywhere, to be your own boss, and to have no limits on how much you can earn. The potential rewards seem endless, and it often feels like the perfect opportunity to escape the constraints of a traditional job or lifestyle. Mark Douglas explains that it's exactly this freedom that makes trading so attractive. Unlike most careers, trading has no boundaries. There's no one to answer to, no fixed schedule, and no cap on how much you can make. You can jump in with just a computer, an internet connection, and a trading account, and suddenly you're in the game. But with this freedom comes a hidden danger. Because there are no clear rules, and because there's no structure enforced by someone else, the trader becomes fully responsible, not just for the decisions they make, but for the consequences that follow. Douglas draws attention to a key issue. Trading gives the illusion of unlimited possibilities, but most people aren't mentally prepared to handle that kind of responsibility. The market doesn't care about your background, how hard you work, or how much money you need. It only responds to your actions. If you don't have structure, discipline, and clearly defined rules, the very thing that attracted you to trading, freedom, becomes the thing that destroys your chances of success. He explains that many traders enter the market with the wrong mindset. They see trading as easy money. They believe that with the right system or a few good trades, they can get rich quickly. This creates dangerous expectations. And when trades start going wrong, as they inevitably do, those expectations turn into disappointment, fear, or even desperation. Douglas emphasizes that consistent success in trading is not about finding a secret method. It's about managing yourself, your emotions, your impulses, and your reactions to the outcomes of your trades. Without structure and discipline, even the best trading strategy won't save you. One of the biggest problems Douglas highlights is the unwillingness to create rules. Traders want to stay free. They resist rules because they think rules will limit them. But in reality, rules are the only thing that create freedom in trading. Rules protect you from emotional decisions. They help you act consistently and make objective choices even when the market feels chaotic. He's clear about this. Without rules, trading becomes gambling. You might win sometimes, but you'll never have control. And without control, there's no consistency. Douglas urges traders to rethink what trading really demands. It's not just about knowledge or skill. It's about structure. It's about mental discipline. And above all, it's about respecting the process. Because the market rewards those who are prepared, not those who are just hopeful. Chapter 3, Taking Responsibility. This chapter is a turning point in the book. Mark Douglas lays out one of the most important truths every trader needs to accept. You are responsible for everything that happens in your trading. It might sound simple, but it's not easy. Most traders don't realize how often they shift responsibility, whether it's blaming the market, a bad tip, a news event, or even their broker. But Douglas is firm. Until you take full responsibility for every trade you take and every outcome you experience, you'll never gain the mindset needed for consistent success. He explains that trading is unique. It doesn't come with structure. There are no managers, no supervisors, no rules unless you create them yourself. You're the one clicking the mouse. You're the one deciding when to enter, when to exit, how much to risk, and how to react when things don't go your way. And here's the core issue. Many people come into trading trying to avoid responsibility, not embrace it. They want the money, the excitement, the lifestyle. But they don't want to feel the pain of being wrong. They want the market to behave the way they expect. And when it doesn't, they feel betrayed. Douglas says this mindset is dangerous because if you're blaming something outside of yourself, you're giving up control. You're saying, I can't win unless the market helps me. And that belief will keep you stuck, reacting emotionally, avoiding losses, and constantly looking for someone or something else to explain why things went wrong. Instead, he urges you to take back your power. He says, if you've lost money, it's not because the market was against you. It's because of how you chose to engage with the market. That's a hard truth, but it's also incredibly freeing. Because once you take full responsibility, you gain control. You stop reacting and start responding. You learn. You grow. Douglas emphasizes that trading isn't about being right. It's about making decisions with clarity, managing risk, and accepting outcomes without guilt, fear, or blame. When you take responsibility, mistakes become lessons, not emotional scars. Chapter 4, Consistency, a State of Mind. Mark Douglas introduces a powerful idea. Consistency in trading isn't about your strategy, it's about your state of mind. Now, most traders think consistency comes from having a perfect system, a flawless method that wins most of the time. But Douglas turns that idea upside down. He says that even the best strategies will fail if your mindset isn't right. Why? Because trading isn't just about logic or rules. It's about how you think and feel when you're in the middle of uncertainty. The market is unpredictable. That's just a fact. Every moment is unique. So when you enter a trade, you don't know exactly what will happen. And that uncertainty is what throws most traders off. It stirs up fear, doubt, hope, greed, all those emotions that pull you away from your plan. Douglas says that consistent winners have learned to think differently. They don't need to know what will happen next. Instead, they've trained their minds to be okay with uncertainty. They understand that any single trade is just one of many, and each trade has an edge, but not a guarantee. That's the key. Thinking in probabilities. Let's say your setup has a 60% win rate. That means over time, you'll win 6 out of 10 trades, but you don't know which 6 will win. So you have to treat every trade the same, no matter how it feels. You follow your plan, manage your risk, and accept the outcome. That's what a consistent mindset looks like. Douglas also points out something really important. Most traders already have a system that works. What they don't have is the mental discipline to follow it without letting emotions take over. They hesitate. They jump in too early. They second-guess themselves. And that inconsistency in behavior creates inconsistent results. So, how do you fix that? It starts by shifting your focus from outcome to execution. You stop obsessing over whether a trade will win or lose, and instead, you focus on doing the right thing every time. Placing the trade when your setup is there, taking the loss when your stop is hit, taking the profit when your target is reached. No hesitation, no overthinking. Douglas says this kind of discipline doesn't come naturally. It takes practice. But once you adopt this mindset, something powerful happens. You start feeling calm. You stop chasing trades. You stop avoiding losses. You become consistent, not just in results, but in how you feel and how you act, trade after trade. Douglas gives us a simple truth. The real edge in trading is psychological. Consistency is not found in the market. It's built inside the trader. And once you realize that, you're no longer at the mercy of the market. You become steady, focused, and fully in control of yourself. And that is where success begins. Chapter 5, The Dynamics of Perception. In this chapter, Mark Douglas dives deep into how we see the market, and more importantly, how our personal experiences, beliefs, and emotions shape that perception. He starts by pointing out something that most traders never stop to consider. 2 traders can look at the exact same chart, the exact same market conditions, and come to completely opposite conclusions. One might see a buying opportunity, the other might see a signal to sell. Why does this happen? Douglas explains that we don't perceive the market objectively. We see it through filters. These filters are made up of everything we've experienced in the past: wins, losses, fears, hopes, beliefs about success, and our self-image as traders. So when new information shows up on the screen, it gets processed through these emotional and psychological lenses. For example, let's say you've had a big loss recently from a breakout that failed. The next time you see a similar setup, you might hesitate. Not because the trade isn't valid, but because your perception is distorted by fear. You're no longer seeing what's in front of you. You're reacting to what happened before. This is where trading becomes tricky. We like to believe we're making rational decisions, but more often, we're emotionally interpreting the data. Douglas calls this the mental environment we trade in, and if it's filled with fear, doubt, or unprocessed losses, it will cloud our judgment. He introduces an important idea. Beliefs define perception. What we believe about the market, about ourselves, and about what's possible creates our internal map of reality. If your belief system includes fear of losing or needing to be right, those beliefs will distort how you interpret each trade. And once your perception is off, your decisions become inconsistent. Douglas compares this to looking through tinted glasses. If the lenses are colored by fear or anger, everything you see in the market will be affected. You'll overreact to normal price movement. You'll miss opportunities. You'll exit early or hold too long, not because your system is wrong, but because your perception is emotionally biased. So what's the solution? Douglas says you need to train your mind to observe the market without judgment. That means separating the present moment from past experiences. Each market moment is unique. Just because something happened before doesn't mean it will happen again the same way. And if you're stuck in fear or regret, you'll miss what's actually happening now. He encourages traders to develop self-awareness, to recognize their emotional triggers, to understand their personal biases. Because once you do that, you start to see the market more clearly, not through your wounds or your hopes, but as it really is. Chapter 6, The Market's Perspective. Mark Douglas gives us a powerful shift in thinking. He encourages traders to stop viewing the market from their own limited perspective and instead try to understand the market from its point of view. He starts by reminding us of something crucial. The market doesn't care about us. It's not personal. It doesn't know who we are, how much we need to make, or how many losses we've had. The market is neutral. It's simply a reflection of all the participants, millions of traders around the world, expressing their beliefs, hopes, fears, and strategies through buying and selling. So, if the market is just a collective output of human behavior, what does that mean for us? It means we have to let go of the idea that the market is against us or unfair. Many traders fall into this trap. They blame the market when trades don't go their way. They feel like they were tricked or that something was out to get them. But Douglas makes it clear, that's just ego and emotion talking. The truth is, the market doesn't do anything to you. It just is a stream of constantly changing information. He then explains that the key to becoming a consistently successful trader is to align your thinking with the market's nature. That means accepting that the market is always right, realizing that price movement is not personal, understanding that every moment is a unique event. If you think the market should behave a certain way because of your analysis, you're setting yourself up for disappointment. The market doesn't owe you anything. It doesn't follow your rules. It follows the collective behavior of all participants. And that behavior is often unpredictable in the short term. Douglas uses this to introduce the idea of mental flexibility. Instead of trying to force the market into our expectations, we need to become fluid in our thinking. We need to let go of rigid beliefs and stay open to what the market is actually telling us, right now, in this moment. He gives an example. Imagine standing in a river with a strong current. If you try to fight the water, you'll struggle. But if you go with the flow, you move smoothly. Trading is the same. Fighting the market by insisting on being right or needing a specific outcome only creates tension, frustration, and mistakes. But flowing with the market, accepting what it gives and responding calmly, leads to more clarity and consistency. Douglas wraps up by reinforcing this truth. You don't need to know what's going to happen next to make money. You only need to align your actions with the probabilities and stay emotionally neutral, regardless of the result. The message is clear. If you want to succeed in trading, stop seeing the market from your emotional, ego-driven view and start seeing it for what it really is. Not an enemy, not a puzzle, just a mirror of collective human behavior. And once you stop fighting it, you begin to trade with it. And that changes everything. Chapter 7, The Trader's Edge, Thinking in Probabilities. In Chapter 7, Mark Douglas introduces a critical mindset shift. Thinking in probabilities. This is a concept that many traders struggle with because it goes against our natural tendency to seek certainty and control. But Douglas argues that this shift is the key to consistent success in trading. He starts by explaining that every trade you take is part of a larger process, and no single trade has a guaranteed outcome. Whether you win or lose on a given trade doesn't matter in isolation. What matters is how you manage your trades over time. Douglas compares trading to flipping a coin. If you flip a coin 10 times, you know it won't land heads up every time. But you know that, over many flips, heads will come up about half of the time. Trading works the same way. You don't know if your next trade will be a winner or a loser, but if you follow your strategy and take enough trades, you'll start to see the probabilities play out. The problem, he says, is that most traders approach the market as if each trade is an isolated event with no connection to the past or future. They place a trade and immediately start hoping for a win. And when they lose, they're disappointed because they expected the trade to go a certain way. But that expectation is the enemy of rational thinking. Douglas urges traders to stop viewing each trade as a do-or-die situation. Instead, they should approach every trade as just one of many, knowing that some will win and others will lose. It's the overall outcome that counts. The key to this approach is risk management. By managing your risk and making sure that your winners are bigger than your losers, you create a scenario where even if you lose more than you win, you can still make money. This is because, over time, the probability of success works in your favor. For instance, if you have a 60% win rate, you can expect to win on 6 out of 10 trades. But the key is not to focus on the outcome of each individual trade. Focus on sticking to your strategy, managing risk, and accepting that losses are part of the process. Douglas emphasizes that successful traders are those who think in probabilities and who embrace uncertainty. They don't need to know what will happen next. They understand that the market is constantly changing, and the only thing they can control is how they respond. The edge in trading isn't found in predicting the future. It's found in managing risk and understanding probabilities. So, what does this mean for you as a trader? It means you have to let go of the need to be right on every trade. It's not about predicting the market's next move. It's about creating an edge by consistently following your process and accepting the randomness of outcomes. In doing so, you'll become more emotionally neutral and more focused on the bigger picture. In Chapter 8, Mark Douglas takes a deep dive into the role beliefs play in trading. He explains that the beliefs we hold about ourselves, the market, and trading have a direct impact on our success or lack of success. These beliefs shape how we approach the market, how we interpret price movements, and how we react to losses and wins. Douglas begins by explaining that beliefs are filters. Every trader comes to the market with a set of beliefs, and those beliefs act as filters through which we interpret everything we see. These beliefs can be conscious or unconscious, but they always influence our decisions. For example, a trader who believes that the market is rigged against them may enter trades with hesitation, expecting failure, which in turn makes them more likely to react negatively when things go wrong. On the other hand, a trader who believes that the market is simply a reflection of probabilities will be much more likely to trade with confidence and clarity. So, how do beliefs affect trading? According to Douglas, beliefs shape perception. If you believe that you're going to lose money, you'll likely interpret price action with a negative bias. You might second-guess your decisions, pull out of trades too early, or fail to take profits when you should. Conversely, a belief in abundance, the idea that there are always opportunities in the market, can make you more open to taking calculated risks and sticking with your plan, even during tough times. One of the most important ideas in this chapter is the concept of limiting beliefs. These are beliefs that hold you back. For example, a trader might believe that they're not capable of becoming successful, or they might have deep fears about losing money, which causes them to avoid taking trades altogether. These limiting beliefs are often rooted in past experiences, like a big loss or a past failure, and they create a mental block that prevents the trader from performing at their best. Douglas emphasizes that to become a consistently successful trader, you need to challenge and change these limiting beliefs. But this isn't easy. Changing beliefs requires self-awareness, patience, and a willingness to confront uncomfortable emotions. He suggests that traders take a step back and examine their beliefs, especially those that are negative or limiting, and ask themselves, is this belief really true? He also advises traders to create empowering beliefs. These are beliefs that support success, such as the belief that they can learn from every trade, that they are capable of making disciplined decisions, and that their losses are just part of the process. Empowering beliefs help create a positive mindset that supports growth and success in the long run. Douglas highlights that trading is as much about psychology as it is about strategy. If your beliefs about yourself or the market are negative or limiting, you will continually find ways to self-sabotage. However, by changing your beliefs, starting with small, manageable shifts, you can rewire your thinking and transform your trading results. Chapter 9. The nature of beliefs. Mark Douglas digs deeper into the essence of beliefs, how they form, how they impact our decision-making, and why they are such a powerful force in trading. This chapter is all about understanding the nature of beliefs, how they shape our reality and influence every action we take in the market. Douglas starts by explaining that beliefs are learned. From the moment we're born, we begin absorbing information from our environment, our family, friends, teachers, society, and we build beliefs based on these influences. These beliefs shape how we view ourselves in the world. For a trader, these beliefs can either empower us or hold us back. The key takeaway here is that beliefs are not facts. They are just interpretations we make about the world based on our experiences. However, many traders treat their beliefs like facts, which creates problems. For example, a trader who believes that the market is unpredictable and always out to get me will likely react to price movement with fear, hesitation, and anxiety. But that belief isn't a fact. It's just an interpretation, often driven by past failures or fears. Douglas emphasizes that beliefs aren't necessarily right or wrong. They're just filters through which we see the world. This is where the issue lies. If we hold limiting beliefs, such as, I'm not good enough, or I can never make consistent profits, we are filtering everything through these negative lenses. So, when we encounter challenges in the market, we tend to magnify those challenges and see them as insurmountable obstacles rather than opportunities to learn and grow. Beliefs also tend to be self-reinforcing. Once we form a belief, we subconsciously seek out evidence that supports it while ignoring evidence that contradicts it. This is known as confirmation bias. For instance, if a trader believes they are unlucky and that the market always seems to go against them, they will pay more attention to the times the market moves against them and ignore the times when it moves in their favor. Over time, this belief strengthens, creating a vicious cycle of self-doubt and frustration. Douglas also discusses how beliefs are formed in reaction to emotional experiences. If a trader experiences a significant loss, that emotional experience can create a belief, such as, I can't handle losing money. The next time the trader faces a potential loss, they may panic, hesitate, or even avoid taking the trade entirely. This emotional reaction becomes a learned belief, and it can prevent them from taking calculated risks in the future. The problem with limiting beliefs, Douglas explains, is that they keep us stuck in the past. We stop seeing the market for what it is, a dynamic, ever-changing environment, and instead, we filter everything through outdated, fear-driven beliefs. This is why it's so important to challenge and reframe these beliefs. Douglas urges traders to be aware of the beliefs they are operating with and to constantly question them. Ask yourself, are these beliefs helping or hindering me? If the belief is limiting, it's time to replace it with a more empowering one. For instance, instead of believing I can't handle losses, a trader could reframe that belief to, losses are part of the process and I can learn from them to improve. He also points out that beliefs about the market are just as crucial. For example, a trader who believes the market is chaotic and random will approach trading with a mindset of fear and uncertainty. But a trader who believes the market moves in patterns and has structure will approach it with confidence and a sense of control. The beliefs we hold about the market shape how we interpret price action and make decisions. We can change our perception of the market and ultimately our results as traders. The more we align our beliefs with the realities of trading, the more we empower ourselves to make objective, confident decisions. Chapter 10. The Impact of Beliefs on Trading. In Chapter 10, Mark Douglas takes a closer look at how our beliefs directly impact our trading behavior. He focuses on the critical idea that our beliefs shape our perception of the market, which in turn influences the decisions we make and ultimately the results we get. Douglas starts by reiterating something we've learned before. Beliefs are filters. Every belief we hold about the market, about ourselves, and about trading is a lens through which we interpret everything we see. These beliefs are often so ingrained that we don't even realize they're affecting our decisions. But they are. He explains that trading is an emotional activity, and emotions are deeply intertwined with our beliefs. If we believe we are in control and that we can predict the market with accuracy, we may act confidently. But if we believe that the market is random, unpredictable, or against us, our actions will reflect that uncertainty, leading to hesitation, overreaction, or even avoidance. One of the most significant impacts beliefs have on trading is that they influence risk-taking behavior. For example, a trader who believes that losing is catastrophic might avoid taking risks altogether. This can result in missed opportunities and stagnation. On the other hand, a trader who believes that losses are simply part of the process may be more willing to take calculated risks, knowing that the occasional loss is just part of the journey. Douglas talks about how many traders struggle with the fear of loss. This fear often comes from a deep-seated belief that losing is a sign of failure, or that losing means you're not good enough. But Douglas challenges this view, arguing that losses are inevitable in trading. In fact, he suggests that if you aren't experiencing losses, you're probably not trading properly, because the market is unpredictable. The key isn't to avoid losses, but to manage them properly. He goes on to explain that the way we react to losses is often more important than the loss itself. If you hold a belief that a loss equals failure, you'll react emotionally, which will cloud your judgment. You might start to revenge trade, trying to quickly make back the money you lost, which often leads to even worse results. Or you might completely shut down, avoiding trades altogether because you're afraid of the next loss. Douglas also introduces the idea of beliefs around money. For many traders, money represents more than just a medium of exchange. It's tied to self-worth, success, or failure. If a trader holds the belief that losing money means I'm a failure, every loss will feel personal and devastating. But if a trader believes that money is just a tool for measuring success, then losses don't carry as much emotional weight. The trader can learn from the experience without getting bogged down by negative emotions. He emphasizes that the most successful traders are those who treat the market as a neutral entity, one that doesn't care about their feelings or their past losses. Traders who can detach their self-worth from their trading results tend to be more objective and better able to stick to their trading plans. Douglas also notes that beliefs around control can affect how traders react to market movements. A belief that I must control every aspect of my trading can lead to micromanaging trades, overtrading, and an inability to accept the uncertainty of the market. On the other hand, a belief that I can control my actions but not the outcome allows traders to accept the randomness of the market while maintaining control over their decisions. When you align your beliefs with the reality of trading, that losses are part of the process and that success comes from discipline and risk management, you become free to make decisions based on probabilities, not fear or past failures. Chapter 11, Thinking Like a Trader. In Chapter 11, Mark Douglas shifts focus to the core of a trader's mindset, how successful traders think, and how you can adopt this mindset to improve your trading results. He emphasizes that trading is not just about having a solid strategy or perfect timing. It's about adopting the right mental approach. To be consistently successful, you need to think like a trader. Douglas begins by explaining that one of the major challenges traders face is that they often treat the market like a personal battle. They think of each trade as an isolated event and tie their emotions and sense of self-worth to the outcome of that single trade. But a true trader understands that trading is a process, not a series of individual wins and losses. A key concept here is objectivity. A successful trader doesn't get emotionally attached to any single trade. They understand that the market will go up and down, and no trade outcome is ever guaranteed. Rather than reacting emotionally to a win or loss, they remain calm, focused, and detached, always thinking in terms of probabilities. Douglas explains that thinking like a trader involves thinking in probabilities, accepting that the future is uncertain, and the outcome of any trade is unpredictable. Each trade is simply an opportunity within a larger process. The market will go up, down, and sideways, and every moment offers a new probability. Traders who think in probabilities are less likely to be shaken by the inevitable ups and downs. They understand that it's not about being right all the time, but about managing risk and executing their strategy consistently over time. He also touches on the idea of mental discipline. Thinking like a trader means sticking to your plan, regardless of what's happening in the market. It's about controlling your emotions, especially fear and greed, which are common pitfalls for traders. Fear can prevent you from entering trades or cause you to exit too early. Greed can lead you to take unnecessary risks or hold on to a trade too long, hoping for more profits. Successful traders are aware of these emotions and have strategies in place to manage them. A key part of thinking like a trader is also accepting losses as a natural part of the process. Douglas argues that traders need to embrace losses, not fear them. If you have a solid strategy and manage your risk properly, then losses should not be a source of stress or self-doubt. They are simply part of the journey. In fact, if you aren't experiencing losses, you're probably not trading properly. The key is to learn from them and improve, rather than letting them shake your confidence or cause you to deviate from your plan. Douglas also talks about mental flexibility, being able to adjust your thinking based on new information. Markets are constantly changing, and what worked yesterday might not work today. A successful trader needs to be adaptable, open-minded, and willing to adjust their strategy as needed. This doesn't mean chasing every new trend, but rather being flexible enough to recognize when the market is telling you something different and responding appropriately. Finally, he stresses that trading is about consistency, not perfection. Thinking like a trader means focusing on the long-term process, not on short-term results. It's about executing your strategy with discipline, managing risk, and letting the probabilities play out over time. The more you practice thinking like a trader, the more natural it becomes, and the more successful you will be. I hope these insights have helped you better understand the mental side of trading and how to approach the market with the right mindset. If you found this helpful, don't forget to like, share, and subscribe to the channel for more in-depth content on trading and finance.